very warm welcome to ICICI Direct and Money Control present Path to Financial Freedom. In this episode, we are joined by Pankaj Pandey, Head of Retail Research at ICICI Direct. With nearly 2 decades of expertise and 15 years at the helm of ICICI Direct's research desk, Pankaj has been instrumental in tracking over 200 companies across various sectors. First of all, Pankaj, welcome to the show and thank you for giving us your time.
Thank you so much.
You know, Pankaj, अब लाख टके का सवाल है जो हर कोई पूछता है, which is right sectors for making the most money but low risk. So I'll start with that. What are your recommendations?
So for a medium term, look at sectors which have not done well in terms of price performance. So last quarter, for example, you had one of the mutest quarter, largely because the steel prices are at a 3-year low, cement prices are at a 1-year low. You have gross refining margins which are substantially down compared to last year. Banking is one big sector which hasn't done much, largely because everyone is anticipating a potential rate cut. So these are the pockets where we haven't seen much of a price performance. And overall valuations also are quite okay.
Yeah.
So really not the rich kind of a multiple which you see for rest of the markets. So for a medium term, yes, all these sectors do have triggers for the next 1 year. So for example, cement, last 1 year prices are at a 1-year low.
Yeah.
Now there is an expectation second half things are a lot more conducive for economic activity to pick up. We had a budget bit late this year because of elections. So
Right.
and then you had an extended monsoon which impacted. So second half looks a lot more normalized. Similarly, the government capital expenditure is also another factor which is expected to pick up in the second half. Obviously, when these segments are slower, the banking activity also sort of
Slows down.
takes a back seat.
Yeah.
So I think the time is ripe for these category of segments to sort of do well.
Get out of the slumber and start performing
Absolutely.
now. Are there sectors where technical analysis is more effective in short-term trading?
So while there is no major historical evidence to sort of support that, but typically what we have seen is that there are some pockets like say banking or you would have IT where you really do not see much of a volatility or relatively this is where the technical indicators sort of do well because in a banking you can't really have a credit growth which can be more than 2x or probably
Correct.
2.5 3x, but beyond that you can't really expect growth to sort of accelerate or deaccelerate. So these are the pockets where the technical sort of works better, but I think cycle is what people should keep in mind, whether it is an accumulation phase or whether it is a distribution phase or a breakdown, because that is where I think it is extremely important which segment or which phase of the cycle you are in and which pockets you've got exposure to.
You know, we are seeing world over very encouraging and new trends with generative AI and technology coming into everything. Having said that, every sector is going through a phase where the regulatory framework is also changing. And we are seeing a lot of traction both in healthcare and in finance, where the risks and the rewards are a big opportunity and are equal perhaps. When we look at compliances in both the sectors and in the coming year, what are some of the things that you suggest people keep in mind when they are trading in these two sectors vis-a-vis regulation and compliance?
So not only these segments or sectors, you have a lot of other sectors where regulations sort of play a very important role. So now you have a big sector like defense.
Right.
Now defense, last 2.5 years, the acceptance of necessity is given to about 8 lakh worth crore kind of a projects. And you have got only one customer, which is government of India, right? And so while exports are expected to sort of pick up, but you still have a majority being driven by. So obviously government policies do
Matter a lot.
Matter a lot. And within that also, you're seeing a quite definitive or different trends. So for example, now you really don't see a defense equipment where the electronics is not a portion of it.
Yeah.
So electronics is becoming a very core component of any defense equipment. I mean, whether it is for Navy, whether it is for Army or for Air Force. So similarly in healthcare, I mean, when you look at, so while what we have seen in healthcare is a more of a traditional way of where we have exported to US or copycat versions or generic versions of the drugs. But what you are sort of seeing now is a different trend. So for example, all your big companies spend 15 to 20% of their top line on doing or coming up with a new product.
Right.
And which is where they require help in terms of right from R&D to a stage where
GCC
they can,
centers here.
So where you can do the commercial production.
Absolutely.
So which is where a new segment is coming up in terms of CDMO. So it is a more of a IT kind of a model,
correct,
along with a manufacturing leg attached to it. So sectors and segments, I think their texture is definitely changing for sure.
That brings me to top sectors to invest, keeping the 5-year horizon in mind.
I think for that, one needs to sort of notice the kind of inherent changes they see. So for example, I think capital expenditure is one segment where everyone would have seen that we are spending more on roads and railways. So to give you some color, we used to spend somewhere about 50,000 crore each on roads and railways, say 5-6 years back. Now what you're spending individually in these segments is 2.5 lakh or more than that. So capital expenditure is a big segment, and you could have beneficiaries like cement, you could have beneficiaries like steel or capital goods or the infra as a segment. And this is likely to remain so also because I think somewhere down the line we have been a service-driven economy. For manufacturing leg to perform, you need capex, and which is what the government has been doing. Then I think there are some segments which are benefiting from the positive regulatory aspect as well. So banking, clearly the borrower behavior has changed in the last 5-7 years. No one wants to lose control of their companies, especially post the insolvency and bankruptcy code. So that is one sector where I think things have changed dramatically. When you look at real estate, also has changed for sure, because I think earlier it used to be a very localized industry.
Right.
Now what you see is that a lot of players are going pan-India, and which is where I think things are changing. And despite the fact that a lot of you see nationwide launches across by bigger players with better balance sheets, I think the overall share of the top players is still about 20%. It used to be about 6-odd%. So even if the industry does not grow, the listed or the organized players are expected to sort of grow. And last not but least, I think you look at the transformation which is going on the energy side. So power is one sector where gone are the days when you were deriving energy from thermal or any other source. Now you see more of renewable, and when you look
energy.
at when you look at AI also requires good amount of data. Auto is changing for sure because gone are the days when you used to have only IC engines. Now you have various hybrids plus pure EVs. And I think core of this is again power. Because whether you are looking at IC engine or EV engine which has to be powered by this thing, or when you are sort of consuming more data, so data centers are required, and that also is required.
Absolutely.
And on top of it, there is a global push for decarbonization in key sectors like cement and steel. For that, I think you require hydrogen, green hydrogen. And again, power is a very integral component of it. So I think these are the sectors which I feel that for next 5-10 years are going to sort of remain very relevant from an investing perspective. Obviously, you'll have some cycles in terms of where these stocks perform. You'll have a period of correction, and then again a rally further.
Okay. When we talk about high market volatility, and if we have to be prepped for it, which are the sectors that get immediately affected by it, and in the future they should be sort of handled with care in terms of keeping yourself and your risks mitigated through the high market volatility?
So I think historically the most volatile segments have been commodity oriented because when you look at a sector like say cement, steel or oil and gas, these are the pockets where we have seen the maximum volatility. But you can't really slot all of them in a similar fashion. So for example, cement is a local commodity, relatively less volatile than what you see for steel. Now, in commodity again,
Oil is a different ballgame altogether. Yeah, yeah, yeah.
Because what happens that in this entire game of demand and supply, if the supply does not sort of come down, because that is where the challenge lies. I mean, look at bulk of the steel capacities in China, and again dominated by government. Similarly, the oil supply is again dominated by OPEC. So if government comes into picture, then your normal demand supply equilibrium is very difficult to sort of maintain.
Right.
So historically, it's been commodities, and if I have to sort of top it up, then I think leverage is something which causes good amount of volatility, because that is when the balance sheet sort of deteriorates. I mean, if I have to sort of quote an example, if I am putting up a power plant of say 1 megawatt, which is going to cost me 5 crores, and I do 80-20 in terms of 80 being debt and 20% being equity. So imagine if the cost were to sort of go higher, or there is a cost war and 5 crore becomes 6 crore, then the maximum hit is going to be taken by the that 20% equity contribution, because you are not really going to revalue the plant at 6 crores. It will be 5 crores only. So that is where the leverage impacts a lot of stock, and we have already seen historically power as a segment getting impacted, or whichever companies which have got high leverage in their books.
In your closing comments, if we are looking at 1 year horizon and we are looking at a 5 year horizon starting 2025, which are the sectors you're betting on?
Like I've been saying, never book out early. So, which is why the eye should be on the longer trajectory of the markets. So from that perspective, you will have capital expenditure beneficiaries, you will have regulatory beneficiaries, or the energy transition beneficiaries, which are going to do well. But yes, if you are looking at say 1 year perspective, then whichever segments which have not done so well, which is the likes of say cement or bank, I can't really say the same thing about steel, because steel is a global commodity. A lot will depend on what kind of prices or what kind of demand which happens in China, and we are already experiencing quite a subdued demand, especially in a key sector like say real estate in China. So these are the pockets for 1 year, but structurally, I already mentioned so these are the segments to sort of look at.
Thank you, Pankaj. Thank you so much for the insights and, of course, your time. And we are hoping that 2025 is a risk-managed yet successful year for most people. Thank you so much.
Thank you so much.
Well, that's a wrap on today's discussion on sectoral content and stock recommendations, from identifying the most promising sectors for high returns to understanding the role of technical analysis in different industries. Pankaj has shared invaluable guidance to help refine your investment decisions. Thank you for watching, and I hope you have a wonderful financial new year.
ICICI Direct and Money Control present Path to Financial Freedom